Hello there, guys. It's Sunday, May 16th. My name is Dave Coker. This is, of course, Talking About Finance. Let's start out. Remember, this is all just a bunch of slides of what me and my friends are talking about. We tend to bounce memes and GIFs and images back and forth all week, and I bring the best to you guys. So we talked about copper last week, and we saw this huge increase in copper, basically a 97% increase. It's absolutely incredible in 1 year. And here's an interesting thing. I've got some research that I'll drop in the link. I'll drop a link to it in the chat box, a comment box down underneath. But basically what's going on with copper is that demand is really, really high, as we know. Prices are really, really high. And normally in these situations, when prices are high, the producers will produce even more, and that will help drop the price. Well, they can't. And this is really fascinating. It's about 1,000 words. I'll drop it in the comments down below. You can actually get an idea of what's going on with the global supply chain. They just don't have the shipping to enable them to deliver more copper. Otherwise, they would. It's really an interesting time for them. Oh, Bitcoin. Yeah, this is a good one. Bitcoin really got whacked, and it got spanked pretty hard. Now, here's the thing, guys. Bitcoin, as we know, there will never be more than 21 million coins made. And Bitcoin goes through a process every 210,000 cycles, roughly every 4 years. It's called the halving, when the rate of production is cut by 50%. The last halving took place May 24th of 2020. And what this chart does, again, this is not my work. I can't remember who did this one. Doesn't matter. What this chart shows, the vertical red lines show the halvings. And you can see, guys, what's going on with these halving events, right? The rate of resupply, I should say, of Bitcoin gets cut in 50%. And if demand remains constant, then price definitely would have to go up. And we know that demand has been increasing. So clearly we're going to see, I should say, another run up in Bitcoin. It's just normal stuff for this cryptocurrency. Now, for years I've told people, you got to buy stuff. You have to invest. So buy stocks, bonds, rental property. I love rental property. And I always said Bitcoin for fun. Because I'll tell you, this is the most volatile thing I've ever owned. And I invested in robot stocks in robot companies back in the late 80s. Who was doing that? Nobody. When I told people I owned these stocks, they thought it was like Terminator. They had no idea. And those things were incredibly volatile. So yeah, it's just a normal event. I certainly haven't sold any Bitcoin. I haven't bought any because I think you know my story. I was buying it every Friday night for many, many years. Stopped in December 2019. I got enough Bitcoin, and I just don't want to have any more exposure to it because I monitor my portfolio across all the assets that are there. But still, we know that Bitcoin is attracting attention from institutional investors. This takes a look at Coinbase's transfers in and out of Bitcoin. And we can see somebody's buying Bitcoin and pulling it out. Major, major amounts of money. And it's really fascinating when you take a look at this, guys, what's going on in this market. It's absolutely incredible that institutional money is using this dip. And I'm no friends, I'm not going to name drop in New York. I talked to them last week, and they're actually accelerating their purchases because of the drop. Oh yeah, this is a great story. If you haven't read it, please go find it. It's absolutely amazing what's going on here. This guy, and I really wish him the best, but I'm not so sure about this, right? So this guy wanted to do something, as the headline says, wanted to do something different. So he read something on Reddit. I read Reddit, fantastic website, very interesting. He found something on Reddit about Dogecoin, and he went in hard. How hard? Well, check this out. He did cash advances on all his credit cards. He took his savings, his life savings from the bank account, and he used Robinhood's margin facility, and he bought $250,000 worth of Dogecoin. So I don't know. I mean, it's a lottery ticket. It doesn't have the demand, for instance, that Bitcoin does. So he's holding $250,000 of Dogecoin. He's currently on paper worth about $2 million. The headline says he's not selling. I don't know if he'd be able to move that much liquidity out, but he's going to hold on. He's like this guy from the GameStop, Diamond Hands from the GameStop saga. He's holding in. Personally, if I'd done that, I would at least sell enough to get my original capital back and maybe, 100%. Maybe, in other words, I would probably sell maybe 500,000 if I bought that thing. But he's holding on, and I really hope it works out well for him. But if you're holding Dogecoin, guys, there's nothing wrong with taking profits. Nobody ever got fired for taking profits. What would be really tragic and sad is if this thing turns overnight and we see a huge drop, and all of a sudden his 2 million drops down below his entry cost, and that would be really, really bad. So it'll be interesting to see exactly what happens. Oh, this is a really good one too. Now, we know we've got these neobanks, and the neobanks in the States recently have started accepting deposits. They've done it in Europe as well. And JP Morgan in particular, if you read my blog, FinTech Flash News, on FinTech Flash News, I've documented where Jamie Dimon's really annoyed at the fact that fintechs are less regulated, neobanks are less regulated than retail banks, and because of that, they can offer higher rates of interest. They don't have to have the entire capital structure that regulated banks, fully regulated banks do. So there's definitely a war. I know what's going on. Of course, I can't really reveal everything, but what's happening is that the incumbents, as I call them, they're leaning on the regulators. Now the regulators are starting to step up, and we're going to see a regulatory clampdown on these neobanks who are accepting deposits. And again, it's just for the benefit or for the protection of depositors. That's why we regulate banks, but it turns out they're not all regulated the same. So that's interesting. All right, guys, and there are other things that are going on. Here I've got the S&P 500. I've got DJCB, which is the Dow Jones Corporate Bond Index. What it is they take a 95 investment grade bonds and they come up with a composite yield, and we take a look at the total return here. And then I've got commodities, and there's been a lot of attention on commodity prices recently. I know I've done my share of posting. Oh, and guys, I think when you see charts like this is my trademark style. I do have to watermark them. They've been popping up all over the internet lately, and that is okay. But when somebody puts their name on it, it's not okay. But in any case, so what I've done here is I tracked these three series out over the past decade. S&P 500 up about 210%, bonds up about 65%, not bad, either trade. Commodities down 54%, but check this out. Look what happened from last year, from roughly from April of last year. We can see commodity prices starting to spike. So even though it's getting painful in some sectors of the real economy because of soaring commodity prices, it is reversing a very long-term trend. And anytime in the markets, guys, when you see these long-term trends reversed, it's significant. And you do have to pay attention to it. Why? One word: profit. You might be able to make money off of it. And here's another one. Maybe things in the States are getting back to normal. I look at lots of obscure economic series, and one thing I like to look at is the JOLT series, Job Opening and Labor Turnover Survey. And here I've got quits, which is a component of the JOLT survey, and I've normalized it. So I haven't just looked at quits. What I've done is I've expressed quits as a percentage of the labor force, which is the correct way to do it. I see other people just pointing to quits, and that's like sort of bizarre, right? So we're looking at the percentage of people in the labor force that are just quitting. And guys, you don't quit your job unless you got a job. Now look what happened in pandemic. We're focusing on the right-hand side. In pandemic, quits cratered. People just didn't quit their job. If they had a job, of course, unfortunately, a lot of people were rendered unemployed, and that's tragic. But if you had a job, you just kept it. And we can see there's three different areas here I want you to pay attention to. January 2020, the first red circle on the right-hand side, 2.07. April 2020, 1.20. That was the depth, the fall to the lowest point. And then it rebounded, and now it's up to about 2.06%. So we're, for all intents and purposes, back at pre-pandemic levels. Very fascinating to keep that in mind. We are seeing, again, all the signs of a real boom in the States, with GDP perhaps coming in about 8% for 2021. We'll have to see, but it's definitely like a boom time in America, and people do have a fair amount of capital, and they're splashing it around. We'll talk about that next week. I got some incredible charts that have come my way about house prices in particular and other things going on in the States. All right, guys, thanks for your time. And keep your eyes open, move quickly, right? You can make money. You can make buckets of money in this market. You just got to be nimble. You got to go in. Oh, and you need to be averse to risk. That's Buying Bitcoin, I'm definitely averse to risk. And even in stocks, I am, although I don't really trade. I tend to invest only for dividends, but I've always got a couple speculative plays going on. I won't tell you what they are. You need to build your wealth, and to do that, you need a portfolio of dividend paying assets, and then you can take that money, it's other people's money, and do cool things with it. So once again, guys, thanks for your time. Have a safe and profitable week. Take care.